Hello, good evening, everyone. Thank you all for attending this webinar. We're going to talk about TSP strategy, planning income before retirement begins. My name is Warren Covert. I'm the founder and principal advisor at GFP, a financial planning and investment management firm geared towards serving federal professionals. I'm a fiduciary and I have a business degree from the Harlem Business School in the Netherlands. That's also where my accent is from. I'm a dual citizen. On every slide this evening, you're going to see a disclaimer on the bottom, but I want to go over it before we look at the rest of the slides. All disclaimers say the same thing, that this presentation is educational in nature. It's not personalized investment, tax, or legal advice. So this evening, we're going to focus on three main areas. First, how retirement is actually financed, where income comes from once the paycheck stops. Second, how investment strategy supports that income plan. And third, the tax considerations that can make a significant difference over time. There have also been several updates under the Secure 2.0 Act, and rather than covering those separately, I'll highlight them where they are relevant for federal employees. Before we talk about investment strategy or taxes, we first need to understand what retirement actually looks like. So for most federal employees, retirement income comes from three main pillars. Your federal pension, this is FERS or FSPS, Social Security, and withdrawals from your TSP. Together, these sources create what we can think of as your retirement paycheck. So the first step in retirement planning is estimating what that retirement paycheck might look like and how these different pieces fit together and evolve over time. Once we understand that structure, we can start looking at how the TSP supports that plan. As the TSP is the main pillar of that retirement paycheck that we're going to look at during this webinar. It's the part of the paycheck you have the most control over today. And when people think about retirement planning, the question they usually ask is, how much do I actually need to save? And of course, running out of money in retirement is not an option, but leaving behind a fully funded TSP is not the goal either. So the real objective is somewhere in the middle. And what we're really trying to do is structure savings so they can reliably produce an income throughout retirement. Essentially creating a steady retirement paycheck that can support your lifestyle for 30, 40, or maybe even 50 years. So instead of focusing only on the size of the account balance, the more useful question becomes, how do we turn your savings into a reliable income? And that's what we'll explore today. And before we get into that strategy, it helps to look at how retirement has changed across generations. So for many older retirees, pensions provided a large portion of their retirement income. For example, I have an uncle who worked for IBM in the 70s and still receives a significant pension from them every month. But that doesn't happen anymore for new workers. Some Gen X workers still have access to pensions like that, but for younger generations, those benefits become less common. Federal employees still have access to pensions, like the FERS and FSPS if you're foreign service, but even there the pensions were much more generous prior to 2013. At the same time, many people hear concerns about the futures of programs like Social Security. And whether those concerns are justified or not, they contribute to a sense of uncertainty. And it's not surprising then that more than half of Americans say they're concerned about achieving financial security in retirement. So what this shift really means for you is that personal retirement savings now play a much larger role in the retirement paycheck. And during your working years, that part of the paycheck you have the most control over is your TSP. By understanding how to build, manage, and eventually draw income from the TSP is becoming increasingly important. Retirement is not funded by account balances alone. It's funded by cash flow. And a large TSP balance by itself does not automatically translate into a retirement paycheck. What matters is how that money is invested, when it's withdrawn, and how those withdrawals are structured over time. Another factor is that the different pieces of a federal retirement plan become available at different times. Your TSP withdrawals can be structured in several ways. And because of that, retirement planning becomes an exercise in coordinating these income streams so they work together. So when I work with clients, we align TSP contributions with goals, time horizons, and risk tolerance. Often that process reveals that someone may be taking too much risk or perhaps not enough. Then in retirement, the focus shifts to how that balance is spent, structured, and withdrawn. So the portfolio supports income over time, rather than simply relying on a fixed rule like the 4% rule. The 4% rule, for those of you who are not familiar, stipulates that in retirement you can withdraw about 4% of your TSP for about 30 years without ever running out of money, if your TSP is properly structured. So the key question isn't just how much money do I have saved, but how those savings turn into a reliable retirement paycheck. And at some point in retirement, federal professionals ask whether their TSP should stay where it is, or whether some of it should be rolled into an IRA. And the important thing to understand is that both structures have advantages. The right choice depends on what features matter most in your situation. The TSP has several unique strengths. One of the most notable is the G Fund, which provides stability backed by the US Treasury. The TSP also offers familiarity and simplicity. And another important feature is early access to your funds. So if you separate from the federal service during or after the year you turn 55, you can access your TSP without the typical early withdrawal penalties. So TSP also allows for Roth in-plan conversions starting this year, which can be useful in certain tax planning strategies. IRAs, on the other hand, offer more investment flexibility. They provide a wider range of investment options and can allow for more flexibility in how withdrawals are structured over time. So the goal here isn't deciding that one is universally better than the other, it's understanding what each structure does well. So once you reach retirement and decide where your funds will be held, the next step is deciding how those funds should be invested. Conventional wisdom often says that when you retire, the goal is to preserve what you've saved. But when we look at retirement timelines today, that assumption is becoming less clear. If someone retires around age 60 or 65, retirement could easily last 30 to 50 years. That's still a long investment horizon in my book, which means at least part of a retirement portfolio still needs to be invested for growth, not just preservation. So retirement investing becomes a balance between two objectives, growth and stability. You want enough growth so your money can continue working over a long retirement, but enough stability so the portfolio can support regular withdrawals without taking unnecessary risk. And there are two major unknowns every retirement plan has to account for. The first is how long retirement will last. So none of us know exactly how long we will live, so the plan needs to work across a range of possible outcomes. And the second is the market itself. So we know markets go up and down over time, but we don't know when those movements will occur or in what order. And that uncertainty introduces something called sequence of returns risk, the order in which market returns occur. This sequence can have a significant impact on how long a portfolio lasts. So in the next couple of slides, I'll walk you through a short example of how that works in real life. So let's look at this example of what retirement withdrawals might look like over time. The orange bars here visualize a percentage of the TSP that this retiree withdraws every year. So in this example, the retiree retires relatively early, mid-50s, and structures their withdrawals so they spend a little more during the early years of retirement, what many people think of as their golden years. And during that time, the withdrawal rate is somewhat higher than later on in retirement. As you see here, later on, the withdrawal rate declines, partly because Social Security turns on here at 70. And for this example, we're assuming that the market earns about 7% every year, based on JP Morgan's forward-looking projections. There are no downs in this example, but that is not how the markets behave in reality. This chart shows the S&P 500 from 2000 through today, which is essentially the same type of market exposure represented by the C fund in the TSP. Over this period, the market actually produced a very strong average return, roughly 13 to 14% a year. But the key point is how those returns arrived. They didn't come in a smooth, predictable path. Some years the market performed far above average, while other years it fell significantly below. And instead of moving steadily upward, the market moved through a series of rises and declines, including major downturns like the '08 financial crisis, along with periods of volatility in more recent years. And despite all that volatility, the long-term trend of the market was upwards. And that pattern, strong long-term growth combined with short-term volatility, is what creates one of the biggest risks retirees face when withdrawals begin. So imagine the same couple from 2 slides ago retiring in 2007 on the eve of the financial crisis. Their savings are the same in this example, their spending is the same, and their investment strategy is the same. The only difference is when the market returns occur. So instead of experiencing growth early on in retirement, they experience severe losses in the beginning, right here, while they are already withdrawing funds from the portfolio. So the portfolio has to absorb market losses and withdrawals at the same time. This is the essence of sequence of returns risk. The average return may be very good, but the order of those returns can dramatically change the outcome of the plan. So in this plan, their initial withdrawal rate is higher than in the previous example, and it goes up and up until they run out of money within 10 years. But the good news is that situations like this don't have to be catastrophic. A well-designed retirement strategy can anticipate these kinds of market environments. In fact, it should. That's why when we look at portfolios with clients that we work with, we're very deliberate at how much market exposure makes sense, given that family's risk tolerance, goals, and needs. And while you're still working, the one thing you can do to help reduce this risk is by thinking how much of your portfolio is invested for growth versus how much is positioned to help insulate the plan from possible market downturns, especially when retirement approaches. So now let's change the retirement date of this family again. In this example, they retire, and that 2008 style crash we just looked at happens in year 10 of that retirement. So by that point, year 10, their portfolio, their TSP, had about 10 years of strong growth in it already. And because of that growth, the portfolio is in a much stronger position to absorb the decline in the markets and handle those withdrawals that they make to fund their retirement living expenses. So even though the retirees would still experience a market downturn, it would be far less damaging than if the crash had occurred right at the beginning of retirement. So you can do everything right during your career. You save diligently, have a good plan, don't withdraw too much from your TSP in retirement. But if the market crashes on year 1, you're going to have to make some adjustments. So this example really highlights the key idea behind sequence of returns risk. The long-term average return of both examples is the same, but when those returns occur can make a very large difference in the outcome of their retirement plan. So we've talked about absolute numbers and withdrawal rates, but when you withdraw from your TSP, not all those funds end up in your checking account. Some get transferred to the IRS. And in this part of the webinar, we're going to look at how taxes affect your bottom line throughout retirement. And let's start with tax-free income. This usually comes from Roth savings, such as Roth IRAs or Roth TSPs. The term tax-free can be a little misleading though. It doesn't mean the money was never taxed. It means the taxes were paid earlier. So when you contribute to a Roth TSP, you pay income tax on those funds today, and the after-tax dollars then go into your TSP. They grow over time, and when you withdraw them from your TSP, both the principal and the gains can be withdrawn tax-free. This is different from tax-deferred savings, which is where most Americans hold the majority of their retirement assets. Traditional TSPs defer taxes today, but withdrawals later are taxed as ordinary income. In fact, there are roughly 4 times as much tax-deferred retirement savings in the US as there are Roth savings. Another category that become more important in retirement is capital gains and dividends. They are often taxed at lower rates than your ordinary income. This rate is often 15% and can be 0% if you keep your taxable income under a certain threshold. And in the next couple of slides, we're going to look at exactly that, how to keep your taxable income low in retirement. So tax-deferred savings are what you hold in your traditional TSP. The way these savings work is that you earn money today and contribute them to your TSP before paying income tax on them. By doing that, you lower your taxable income today. But when you withdraw the tax-deferred funds from your traditional TSP, those withdrawals are taxed as ordinary income. One of the key features of tax-deferred accounts is something called RMDs, required minimum distributions. So the IRS allowed you to defer taxes during your working years, but eventually they want to collect taxes. And as per Secure 2.0 updates, for anyone born after 1960, RMDs begin at age 75. At that point, the IRS requires you to start withdrawing funds from your traditional TSP every year. So these withdrawals are not required because the IRS is worried about your spending needs. They're required because those withdrawals create taxable income. And as account balances grow within your TSP, those RMDs can become quite substantial over time. Once they begin, they continue for the rest of your retirement. And RMDs don't just affect the income taxes you pay today. They'll influence several other parts of your retirement finances as well. So in retirement, a large portion of your taxable income will typically come from sources like pensions, Social Security, and withdrawals from your traditional TSP or IRAs. The more taxable income you have, the more income tax you pay, just like when you're working. And that income determines your marginal income tax bracket. But income taxes are only one part of that story in retirement. Taxable income can also affect how much Social Security benefits become taxable. And it affects your Medicare premiums. Medicare has something called IRMA surcharges. These are essentially income-based surcharges on Medicare premiums. But unlike regular income tax, which is progressive, Medicare tax brackets are threshold-based. That means even going over $1 can trigger a higher premium level, which can increase costs fairly quickly. And the way retirement income is structured doesn't just affect taxes today, it can influence healthcare costs, Social Security taxation, and even how those assets transfer to the next generation. So if taxable income affects income taxes, Social Security, and Medicare premiums, and even estate outcomes, question becomes, how do we manage that? The main way we do that is by building tax diversification, spreading retirement savings across different types of accounts that are taxed differently. And this is something you can start on today. Instead of relying entirely on tax-deferred accounts like your traditional TSP, you can also save in a Roth account or a taxable investment account. And because of these accounts, their tax status is different, they give you flexibility to decide which source of income to draw from in retirement. So one important thing to remember is that retirement expenses are not perfectly linear. Some years are predictable, but other years can be much more expensive. You might need a new car, decide to buy an RV, a new property, or help out a family member. And because of that, tax diversification becomes more than just save taxes. It creates options. I'll explain by two examples. Imagine you're retired and your pension, Social Security, and traditional withdrawals already place you in the 12% federal income tax bracket. If you withdraw more from your traditional TSP, you could push yourself into the 22% bracket. Instead of doing that, you could stop withdrawing from your traditional TSP and draw from your Roth TSP, which is tax-free, and from a taxable investment account, where the gains may be taxed at the long-term capital gains rate, which is often preferential. That flexibility allows you to manage your tax bracket rather year by year than accidentally escalating into a higher one. So withdrawing from your taxable account or your Roth TSP in this example will never escalate you into the 22% federal income tax bracket. Another benefit of tax diversification becomes clear when a large expense comes up. Let's say you need $200,000 in any given year in retirement. If you've only saved in your tax-deferred traditional TSP, you might need to withdraw closer to $300,000 to net $200,000 after taxes. But if you've diversified your savings, you have options. If the funds come from a Roth TSP, withdrawing $200,000 gives you $200,000 after tax. And if the funds come from a taxable investment account, where you pay capital gains tax at 15%, you only need to withdraw $230,000 to cover that 15% tax rate. So building these different tax buckets during your working years can significantly expand your flexibility and options later on in retirement. The last benefit of tax diversification I'm going to talk about has to do with estate and legacy planning. And specifically, tax diversification can help protect a surviving spouse. So when couples file taxes together, they benefit from wider tax brackets. But when one spouse passes away, the surviving spouse will file as single, which means those tax brackets become much more compressed. So even though the surviving spouse might have a similar income, the tax bracket will be higher. Having Roth or taxable assets available can help manage that situation. So I've prepared another case study to show how each of these taxes work in retirement, and afterwards we'll open it up for questions. So in this example, we're looking at the same household from earlier, the slides with the orange withdrawal rates. But now we're tracking their taxable income across their lifetime, from their working years into their retirement. And we'll see a little spike here. That's the sale of an asset in the plan, which in that year pushes them into a higher tax bracket. So the blue area represents their taxable income every year. And this green line here shows the thresholds for the 12% tax bracket. Income above this green line gets taxed at 22%. Income below this line gets taxed at 12%. And income above this line, which happens here in their 40s, gets taxed at 24%. So while this couple is working, most of their income sits in the 22% bracket. That means every dollar they contribute to a traditional TSP is effectively deferring taxes at about 22% here. If they withdraw that money from their TSP from their mid-50s to about their 70s, they only pay 12% income tax on it. So having a good estimate, a good overview of what your taxable income will be throughout your career and retirement gives you a pretty good idea on deciding whether you should save in your traditional or your Roth TSP or a mix thereof. So they can withdraw early in retirement under the 12% federal income tax bracket. And for a period of time that actually works. So when they retire in their mid-50s, their taxable income drops significantly right here because their W-2 salary disappears. But as retirement progresses, something important happens. At around age 70, Social Security begins. In this case, Social Security can start as early as 62, but in this plan, it starts at 70 to increase the benefit. And once that happens, their taxable income gets pushed back into the 22% federal income tax bracket. And at age 75, RMDs push their income even higher, but still within the 22% federal income tax bracket. And over time, those RMDs, the top part here of their income, push their income to the highest levels it has ever been throughout their career or retirement. So while traditional tax deferral can work in this case, concentrating too much savings only in your traditional TSP can create further tax pressure down the road, especially when RMDs begin. So on the previous slide, we saw what taxable income drops when a household retires because their salary disappears. But their income does not disappear. It simply changes sources. While you're still working, most of your income will probably come from your salary and other W-2 income, which is the dark blue portion again in this slide. But once retirement begins, income starts coming from several sources at the same time. You can see that right here. The purple part here is pension income. The blue part here is income from investments. This is where they live on early in retirement when they're in that low 12% income tax bracket. But when Social Security starts, it's green here, it adds another layer to their income. And then at 75, withdrawals from their tax deferred account, or RMDs in this case, add a fourth layer of income to their picture. Instead of only looking at your W-2, perhaps some investment accounts, suddenly you have to track multiple income sources, which brings a little bit more nuance to the picture. But especially when you're tax diversified, this opens a lot of opportunities like we've discussed earlier. But because of this nuance, it's increasingly important to plan for where your retirement income comes from ahead of time so that you retain control over the money that comes in. Now let's zoom in here on the RMDs in this plan, required minimum distributions. So in this example, RMDs rise to about $100,000 a year fairly quickly, eventually even higher. And if you remember, in this scenario, the retirees are in the federal income tax bracket that charges them 22%. And they have no choice over these RMDs. In fact, if they don't take these RMDs, they'll get a 10% to 25% penalty on these RMDs. With the latest Secure 2.0 updates, that penalty is actually 25%. It used to be higher. So every time they take a distribution in the form of an RMD, the IRS is effectively saying, for every 100,000 you withdraw, 78 goes to you, 22 goes to us. Pleasure doing business and see you next year. That's why retirement planning isn't only about investments. A large part of the work I do with clients involves planning the tax structure of retirement income so the client's tax bill doesn't balloon at some point. So these are the last series of brackets I want to show you, and they are the Medicare premium income tax brackets, or the IRMA surcharges. So in this example, we're looking at the first two brackets, or tiers as Medicare calls them, although they have more. You see them here, they're a little bit grayed out. They're not applicable to this case study. So households who keep their income below the first tier, the blue line here, they won't get hit with a surcharge. But the moment their income goes over that line, even with $1, Medicare adds that surcharge, and that surcharge is about $96 a month. Now, if they would cross the green bracket, the green tier, that would turn into a $240 a month surcharge. And notice what happens in this example. So when these retirees are in their 60s and early 70s, their income is comfortably below the threshold. Doesn't mean they don't have a lot of money available, it just means they pull money from different accounts that won't affect their income in the way that Medicare looks at it. But once RMDs start here at 75, the household has less flexibility because those withdrawals are all taxable income, which counts towards your Medicare income. Even though those RMDs don't push them into a higher income tax bracket, they're still on the 22% bracket. They do push them above the Medicare surcharge threshold right here. So suddenly they begin paying higher Medicare premiums, even though their income tax bracket did not change. One example I often help clients navigate is Roth conversions during retirement. They're available now within your TSP starting this year, but converting too much in a single year can unintentionally push your income above one of these Medicare thresholds. However, not converting enough might not have the desired effect. So there is a delicate balance here to strike. Not convert too much that your income crosses the blue line here, the threshold, but if you don't convert enough, you might not lower your income to a place where you don't get hit with Medicare surcharges. And this really highlights an important point that retirement income planning today involves navigating a number of overlapping rules on top of managing an investment strategy. Taxes, Medicare premiums, and RMDs all interact, and without careful planning, it's easy to trigger unintended tax consequences. So to summarize what we've covered today, and it's quite a bit, building wealth and distributing wealth are equally important parts of retirement planning. The second takeaway is that taxable income in retirement affects more than just your marginal income tax bracket alone. It also influences Medicare premiums and other income thresholds. The third takeaway is that flexibility across tax buckets creates long-term control, and when savings are spread across tax-deferred Roth and taxable accounts, you have more options for how and when you withdraw your funds in retirement, and ultimately, flexibility allows retirement income to be managed in a more tax-efficient way over time. So thank you all for your time today. If it would be helpful to talk through how these concepts apply to your own situation, feel free to send me an email or book some time on my calendar by scanning this QR code. Let's open it up for questions.